Imagine you just paid like $189 for this exclusive premium service, right? Just to feel like an absolute VIP at the airport.
Oh, yeah. You walk in expecting the red carpet.
Exactly. You walk up to this security checkpoint feeling great, only to watch the totally regular TSA PreCheck line absolutely breeze right past you.
It's brutal.
It is. And you are just stuck standing there staring at a broken kiosk, waiting for a human ambassador to um, verify your identity. That scenario is the frustrating reality for millions of travelers right now.
Yeah, it really is a striking visual.
Welcome to the Byte-Size Brief. Today we are putting clear, secure, YOU, that's YOU, completely under the microscope. Let's get into it.
It gets right to the heart of what we were unpacking today, honestly.
Listeners, we are looking at a truly fascinating, almost unbelievable contradiction in the market right now. If you look at the stock chart for Clear Secure, ticker YOU, you'll see this massive, like 37% mid-session surge that happened back in late February.
Right, which was massive.
Huge. And it was entirely driven by what Wall Street called a blowout Q4 2025 earnings report. But then fast forward to late March, and we see an 11% market-driven dip, bringing the stock back down to around the $51 mark.
Yeah, it is the absolute definition of a split narrative. I mean, on one side of the ledger, you have the raw financial data,
Right.
which paints a picture of a highly efficient cash-generating machine that is just firing on all cylinders. But then, on the other side, you have the physical reality of the product at the airport.
Which is under severe stress, to put it lightly.
Exactly.
And that is the core mystery for you, the listener, right? How can a company post such incredible record-breaking cash flow and absolute monster membership numbers while simultaneously facing incredibly loud viral complaints from its everyday users?
It's everywhere online.
If you spend 5 minutes on any travel forum right now, people are just furious about these lines.
It's a paradox, for sure, but we have to understand that it is a highly, highly profitable paradox.
But profitable how?
Well, while those airport lines might look messy, chaotic, and frankly broken to the person standing in them, the balance sheet tells a very complex story. To understand where Clear Secure, ticker YOU, is actually heading, we really need to strip away the emotion of a bad travel day.
Right, take a step back.
Exactly. We need to take a purely objective look at the hard numbers, because that late February stock surge didn't happen by accident.
Okay, let's start with those Q4 calendar year 2025 highlights then. We need to unpack the actual mechanics of this earnings pop.
Sure.
What exactly did Wall Street see in the data that made institutional investors hit the buy button so aggressively?
They saw a level of operational efficiency that you rarely see in a company managing physical infrastructure. I mean, top-line revenue hit $240.8 million.
Wow.
Yeah, which is a very solid 16.7% year-over-year growth. But top-line growth is just the appetizer here.
What was the main course?
The metric that really blew the doors off Wall Street's expectations was their adjusted EBITDA.
Okay, let's unpack that for a second because, financial jargon can get dense. Adjusted EBITDA earnings before interest, taxes, depreciation, and amortization.
Right.
When we look at a software company, high EBITDA makes sense. But Clear Secure, ticker YOU, operates physical kiosks. They have those massive blue lanes taking up expensive airport real estate.
Yep, they do.
And they have thousands of human ambassadors working the floors. How are they pulling off software-like margins in a hardware world?
That is exactly why the market reacted so violently. Their adjusted EBITDA came in at $79.87 million. That represents a massive 33.2% margin.
That's crazy for physical tech.
It is. And they achieved this because the bulk of their heavy infrastructure spending is largely behind them now. The human ambassadors are expensive, yes, but the actual biometric verification network scales incredibly well.
So once it's set up, it's just running.
Precisely. Once a kiosk is installed and humming, processing the next 1,000 passengers costs them practically nothing in terms of marginal expense.
Hold on, how does that actually affect Clear, Secure, YOU stock price for regular investors like me?
Well, it fundamentally changes how the company can deploy its cash. And that comes down to a vital metric, the customer acquisition cost, or CAC, payback period.
Okay, CAC payback.
Right. In Q4, their CAC payback period was an incredibly lean 8.2 months.
Wait, 8.2 months. Let me make sure I'm translating the mechanism of that correctly.
Polite.
If they spend, say, $50 on marketing to convince you to sign up for an annual subscription, they have completely earned back that $50 expense in just 8 months of your membership fees.
Precisely. And in the world of subscription models, that is a staggering velocity.
Really?
Oh, absolutely. Most SaaS companies or subscription boxes are absolutely thrilled if they can recover their marketing costs in like 18 to 24 months.
So basically, it's kind of like a gym membership where the gym makes back all its marketing money on your sign up before your first year is even over.
That is exactly the mechanism.
And not only that, but they don't even need to take out a loan to build a new gym because your membership is already funding the expansion.
Yes, recouping the acquisition cost in 8.2 months means that every customer they signed up during the spring travel season is generating pure, unencumbered profit by the winter holidays.
That is wild.
This efficiency gives management a massive war chest. They aren't scrambling to cover past marketing debts. They have the resources to aggressively reinvest into the business.
Like developing new tech.
Exactly. Develop brand new technologies or simply weather an economic downturn without ever having to dilute their current shareholders by issuing more stock.
Okay, so compared to last quarter, what actually moved the needle here?
The most dramatic sequential shift, the thing that really caught analysts off guard, was their free cash flow. It swung violently in a positive direction.
How violently?
Well, in the prior quarter, they were sitting at a negative $53.47 million in free cash flow. Fast forward to Q4, and that number skyrocketed to a staggering positive $187.4 million.
Wow. From burning over $50 million to printing almost $200 million. But how does a swing of that magnitude actually happen mechanically in just one quarter?
It's a great question.
Did they just suddenly stop paying their bills?
No. It represents the completion of some incredibly heavy lifting. Throughout the previous quarters, management had been intentionally pouring cash into capital expenditures, what we call CapEx.
What were they building?
Specifically, they were rolling out highly automated physical biometric e-gates across major airport hubs and simultaneously migrating their entire back-end billing system.
Oh, man.
Yeah, upgrading physical hardware at airports involves union labor, security clearances, and massive logistical costs.
So they were essentially renovating the house while still living in it.
Exactly. But in Q4, those massive infrastructure investments were finally completed. The CapEx just dropped off.
Right. The bill stopped coming in.
And the moment those expenses vanished, the pure subscription revenue from their massive user base just flowed straight to the bottom line. Furthermore, their total bookings accelerated to a 25.4% growth rate.
Which is huge.
It's the highest growth velocity they've seen since 2023.
Okay, the cash flow is an absolute geyser right now. But you are the analyst here, and I know you've got the bear case hiding somewhere in these quarter-over-quarter metrics.
I always do.
What is the dark cloud on this balance sheet?
The dark cloud is retention. Specifically, we have to look at gross dollar retention, and it is flashing a warning sign right now. It dropped for the 5th consecutive quarter, hitting 86.4%.
Wait, let's translate gross dollar retention for a second to make sure we are totally clear on the mechanics.
Sure.
Does that just mean out of every $100 they made from recurring subscriptions last year, they are only keeping about $86 this year because people are actively canceling their memberships or refusing to renew?
That is the exact translation. In a recurring revenue model, consecutive declines in retention indicate a structural problem with user satisfaction.
Because if people love it, they don't leave.
Exactly. If people love the product, that number stays in the mid-90s. 5 quarters of decline means the core product is losing its stickiness.
Ooh.
But here is where it gets highly controversial from a corporate governance perspective. Management just announced they were discontinuing the reporting of key performance indicators, or KPIs, starting in Q1 2026.
Wait, stopping reporting on retention, isn't dropping KPIs a classic corporate magic trick to hide a leaking bucket from investors?
It is a massive red flag for institutional investors, and you have every right to be skeptical. Specifically, they are stopping the reporting of that exact metric, annual gross dollar retention.
Unbelievable.
They're also dropping total cumulative platform uses. Moving forward into 2026, they will only report on total Clear members and active Clear Plus members.
So hiding the retention rate is essentially like a restaurant bragging to the street about how many new people walk through the front door, right?
That's a good way to put it.
While completely refusing to tell you how many of those people sent their food back to the kitchen and demanded a refund. If your retention is dropping, but you only report total active members, you can just mask all the unhappy people canceling by flooding the top of the funnel with aggressive marketing or free trials.
You've nailed the exact risk profile. By obfuscating the churn rate, management is requiring investors to rely entirely on cash flow metrics moving forward.
Which is scary.
Very. Because if top-line member growth ever slows down, say, if travel demand dips, that hidden churn rate will instantly eat into their profitability. And we won't have the data to see it coming until it actually hits the bottom line.
So to understand why that retention rate is dropping quarter after quarter, we have to look at the physical product experience right now.
We do.
And listeners, if you travel frequently, you know exactly what we were talking about. The friction at the airports is intense.
It's palpable.
Everyday travelers are noticing that the regular vanilla TSA PreCheck lines are often moving significantly faster than the premium clear secure ticker YOU lines. We are seeing this bottleneck effect at major high-volume hubs like Newark, Denver, San Francisco.
And this friction defeats the entire psychological value proposition of the product.
Right.
If you are paying roughly $189 a year for the privilege of skipping the line, and you watch the free line moving faster, your perceived value of the service instantly plummets to zero.
And from what we see in the sources, a lot of this bottleneck is being blamed directly on the rollout of their next-gen Identity Plus updates. But this isn't just a simple software patch happening silently in the cloud.
No, it is a highly disruptive physical upgrade. Mechanically, they are shifting from legacy biometric algorithms to much higher fidelity facial vectors to meet new security standards.
Okay.
And to make that leap, the system requires existing members to literally re-enroll their biometrics right there at the security checkpoint.
So instead of a traveler walking up, doing a quick 2-second retina scan, getting the green light, and walking through to the bins, they're just stuck standing at the kiosk.
Exactly.
They have to retake photos, verify updated data, and essentially do paperwork while everyone else waits behind them. No wonder the lines are backing up.
Mechanically, it is a nightmare for throughput. The human ambassadors are spending their time acting as tech support rather than expediting passengers.
That makes total sense.
However, as an analyst, I have to balance this anecdotal narrative with the actual consumer data, because the data we are seeing contradicts the online outrage.
I'm not sure I buy that. How can the data contradict thousands of people complaining about missing their flights?
Because despite the visible friction at the airports, in March 2026, their new app downloads absolutely exploded to 289,000.
Wait, what?
Yeah, that is up 3 times year over year.
3 times the downloads while the service is objectively slower? That makes no sense unless those downloads aren't actual loyal travelers.
What do you mean?
Could those just be people downloading the app in a panic while standing in a massive 2-hour TSA line, hoping they can sign up for a quick free trial on their phones to save them from missing their flight?
That is a very astute hypothesis,
Yeah.
and it absolutely plays a role. We are seeing broader macroeconomic anxiety around travel right now. General TSA congestion is hitting all-time highs across the country.
People are stressed out.
Yes. Plus, we're already seeing early travel preparations and anxiety building for the 2026 World Cup in North America. People are terrified of airport chaos, so they are downloading the app as a desperate insurance policy.
So it's less about brand loyalty and more about a hostage situation, like, I will download anything to get out of this line.
Exactly.
Yeah.
Additionally, we have to factor in their vital partnership with American Express, which was just successfully renewed.
Ah, the credit card subsidies, the illusion of a free product.
Precisely. A massive portion of their user base does not actually pay the $189 retail price out of pocket. Premium credit cards fully subsidize the membership.
Right.
So even if the user experiences friction and annoyance with the next-gen Identity Plus rollout, the actual cancellation rate isn't as catastrophic as it would be if they were paying hard cash, because the perceived cost to the consumer is zero.
But even with those Amex subsidies padding the numbers, Clear Secure, ticker YOU, is facing a severe structural threat from the very infrastructure they rely on the airlines themselves.
Yes, they are.
We are seeing massive carriers like Delta heavily testing their own in-house biometric touchless ID systems.
This is the existential threat to their legacy business model. Airlines are developing facial recognition systems that allow a passenger to go from the bag drop at the curb straight through security and onto the plane at the gate using nothing but their existing airline app profile.
Right, but what does all that actually mean for Clear Secure YOU investors?
Means the competitive moat around their core consumer airport business is rapidly shrinking. If Delta or United can seamlessly verify your identity using their own proprietary systems, the need for a third-party middleman subscription service evaporates. Yeah. If the airport physical real estate is saturated, the lines are frustrating, and the airlines become direct competitors with faster tech, the legacy travel business cannot be the sole driver of future growth.
If the airlines are building their own fast lanes, Clear's airport real estate suddenly looks like a dead end. They had to know this was coming. Is that why they are suddenly courting hospitals and completely shifting their business model?
Yes, they are executing a massive, heavily capitalized pivot. They are taking their world-class, highly authenticated biometric technology and deploying it into a completely new, infinitely larger sector.
It is.
They are leaning incredibly hard into their B2B enterprise platform, which they call Clear One.
Okay, let's explore the mechanics of Clear One, because identity verification at an airport is about skipping a line. But in the corporate world, identity verification is about hardcore cybersecurity.
Exactly. In a world that is becoming increasingly compromised by AI and deepfakes, corporate workforces are facing unprecedented insider risks and data exfiltration threats.
It's a huge problem right now.
How do you know the person logging into the corporate intranet remotely is actually your employee and not a deepfake bypassing a password prompt? Clear One is stepping in to act as the ultimate verification layer, ensuring the human behind the device is who they say they are.
And they are pitching this to Fortune 100 companies.
Yes, aggressively.
But the absolute crown jewel of this pivot, the thing that really caught my eye in the sources, is their aggressive move into healthcare.
Oh, it was massive.
They just secured a massive multi-year contract with CMS, that's Medicare, as well as Mount Sinai hospital systems. The sources describe them acting as an identity interoperability layer to prevent healthcare fraud. How does that actually function in a hospital setting?
Think about the friction of the current healthcare experience. You walk into a hospital and you are handed a clipboard with a stack of papers to fill out your medical history, your insurance, your social security number.
You're the worst.
It is ripe for identity theft and billing fraud. CMS is the largest healthcare payer in the United States, and fraud costs them billions.
So how does Clear One fix the clipboard?
By integrating Clear One into the back end of these hospitals, they are establishing a one-and-done secure identity layer. Instead of filling out vulnerable paperwork, a patient's biometrics instantly link to a verified, immutable digital identity that CMS trusts.
Oh, wow.
Management refers to this strategy internally as killing the clipboard. It modernizes account creation for millions of beneficiaries while simultaneously wiping out low-level identity fraud.
So basically, it's kind of like they use the airport to build their brand and 38 million member database, but the real money is becoming the digital bouncer for hospitals and corporate America.
That is the exact strategic roadmap. From an analytical perspective, the airport was a highly profitable proof of concept. It normalized the behavior of biometric scanning for 38 million Americans.
Which is true. 10 years ago, people were hesitant to give their fingerprint or retina scan to a private company.
Exactly. And today, it is second nature. Now, they are monetizing that normalized behavior in the massive enterprise space.
And this enterprise pivot isn't just a pipe dream. I mean, they have the cash to actually build it. It is fully funded by their massive 2026 guidance. Management is projecting at least $440 million in free cash flow this year alone.
$440 million gives them incredible room to maneuver. It pays for the enterprise sales teams, the software integration, the cybersecurity audits.
All of it.
And management is projecting absolute confidence with that cash. They didn't just hoard it, they just hiked their dividend by 20%, and they added $125 million to their share repurchase program.
Let's talk about the mechanics of that signal. When a company is aggressively buying back its own stock in the open market while simultaneously hiking the dividend payout to shareholders, what is the message they are sending to Wall Street?
The message is, we believe our stock is undervalued, and we believe our internal enterprise pivot is already working. They are putting their money where their mouth is.
And the street is listening.
Institutional sentiment is finally starting to catch up to this B2B strategy.
Yeah.
We saw D.A. Davidson recently raise their price target on the stock to $65.
It is honestly a brilliant bait and switch. You hook the consumer with the promise of a faster airport line. You endure the massive operational headaches of dealing with physical kiosks, union labor, and TSA regulations. But you emerge on the other side with one of the most robust, fully authenticated biometric databases on the planet.
It's an incredible asset.
And then you pivot and lease that authentication engine to hospitals and financial institutions.
It completely transforms their identity. They go from being viewed as a luxury travel utility, which is vulnerable to airline competition and travel downturns, into a core foundational cybersecurity infrastructure play.
Right.
The revenue from these enterprise hospital contracts is incredibly sticky, it's recurring, and most importantly, it does not rely on how long a physical line is at Terminal C in Newark.
Let's bring this all together for the listeners because the ultimate tension here is incredibly stark. You have a company with a frustrated legacy consumer base dealing with physical bottlenecks and dropping retention metrics at airports, juxtaposed against an incredibly lucrative, cash-gushing enterprise future built on the back of healthcare and cybersecurity. It's a fascinating dynamic. The leaky bucket in their consumer travel retention might not even matter if their enterprise pipeline continues to explode at this rate.
That is the ultimate billion-dollar question for investors. Can the massive cash flow generated from their legacy travel operations sustain them long enough for Clear One to become the dominant revenue engine?
Right.
The financial data from Q4 strongly suggests they have more than enough runway to make it happen. But execution in the B2B space requires a completely different sales motion than consumer signups.
Before we go, think about this. If Clear Secure, ticker YOU, actually succeeds in becoming the ultimate B2B identity layer for hospitals, enterprise corporations, and banks, your biometric scan isn't just your boarding pass anymore. It becomes the master key to your entire digital life.
It really does.
In a world plagued by deepfakes and AI fraud, maybe we desperately need a centralized digital bouncer. But the sheer scale of a single private company holding that much authenticated power is definitely something to ponder as they transition out of the airport and into our medical records.
It's a huge shift in how we handle our identity.
All right, listeners, what's your take on the future of Clear Secure, YOU? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Bite-Size Brief.